Good evening, everybody. This is Parag Mehta here, along with CA Ankit Joshi. So the today's webinar is regarding GST on builders and developers, JDA agreements, impact on landowners and builders. So the way we propose to go about is we would be taking up the notifications 3/2019 to 9/2019. So this is where the entire genesis and the foundation lies for levying the tax on construction by the builders, as well as free areas allotted to the landowners and JDA agreements, maybe area sharing or revenue sharing, and some judicial precedents. Though GST does not have much of a judicial precedents, these are judicial precedents for the erstwhile service tax, wherein also there are issues and disputes regarding the free area allotted to either the society or the landowner. So I will request C. Ankit Joshi to share his screen. Once he is through with it, then we'll discuss on the GST implications for revenue and area share, and then take up the question and answers which would flow through. Over to Ankit Joshi.
Thank you, Parag. Just I'll share my screen. I hope everybody is, able to see my screen. Good evening, friends. Welcome to this webinar on GST implications on joint develop agreements for builders and developers. So now, before starting the presentation, I would always say, especially in construction sector, so construction sector has a special place in GST. Now, where I am coming to this, because construction is the only sector where you'll find it has its own GST rates of 1%, 5%, 12%. It has its own valuation mechanism, be it land valuation and everything. It has its own RCM applicability in terms of TDR, which is not applicable to any other sector. For other sectors, we have provider of service or recipient of service. But same thing in case of builders and developers, it starts with owner, developer, promoter. These are the terminology that gets used. So one can say, construction sector can have a separate GST law in itself. So one can always say, if there are so many clauses in for a construction sector, it comes with its own issues and its own queries. So through this webinar, we'll try to, shed some light if for our construction friends, and it will be great if we will be helpful to them in any of the way. So let's start with that. Okay. So real estate sector, broadly can be divided into two parts. One pre March 2019 and one from April 2019 onwards. So from the inception of GST till March 2019, the scenario of GST was if there was a sale of, under construction affordable units, GST would be charged at 8%. And if there was a sale of under construction residential units other than affordable or a commercial unit, the GST would be charged at 12%. And in both the scenarios, ITC was available, whether it is ITC of input services, capital goods, ITC was available. However, from 1st April 2019, there was a drastic change. So what happened in that? So just a synopsis, we will be covering detail later on. So what happened there is that in case of there was an under construction sale of flat for affordable units, only GST was leviable only at the rate of 1%. In case of under construction residential flats other than affordable units, GST was 5%. In case of commercial units as a part of RREP projects, which is residential real estate project where commercial area is less than 15%, again GST was charged at 5%. And in cases when there was a under construction commercial units or exclusive commercial projects, in case of REP projects, GST was charged at 12%. One of the things that to be noted that in case of residential units or a commercial complex in RREP units, no ITC was allowed. And ITC was allowed only in case where the project was either in REP commercial project, in REP project, or an exclusive commercial project. In that case only ITC was allowed. Other ITC is allowed Other than that, in other cases, ITC is not allowed. So let's see what changes were exactly there from 1st April 2019. So as on 1st April 2019, whatever the projects that were ongoing, so here they had defined what was ongoing projects. So in case ongoing projects, so all the projects where commencement certificate was issued before 1st April 2019, that is 31st March 2019, no completion certificate or the occupation has been done before March 19, and partly or wholly some of the apartments were sold before March 2019. If these were the criteria that were met, then the project was qualified as an ongoing project. So whoever there were builders who there were ongoing project as on 1st April 2019, they had to opt for one of the option, either to pay tax at the current rate, which was 8% or 20%, whatever applicable, and can avail the input tax credit, or or pay GST at the rate of 1% or 5% without any ITC. And in order to opt for that scheme, they had to file a form which was notified by 10th of May, which was subsequently extended to 20th of May. In case if any of the builders had failed, file the notified, it will be assumed that the builder has opted for the new taxation scheme. So if any of the builders currently were still not filed and are continuing with the old rates, this can be a litigated issue. So if any of the builders opted, continue to go with the old scheme, so and the project is still under process currently also. So what will be the current scenario for them? So in case of it is a residential affordable house, they will be charging GST at the rate of 8% along with ITC. If there are residential other than affordable, it will be 10%. In case of commercial, it will be 12%. In all these cases, ITC was available. So what happens to the ITC thing in this case? So if you are opting for the old scheme, then in this case, all your ITC as on 31st March 2019 remains intact. Even after that, if any ITC that has been availed after 1st April 2019 respect of input, capital goods or input services, the same can still be availed. Here, the assessee will still have the option to discharge its liability through ITC balance, whatever is the available. One of the condition in the new scheme was that you are required to procure all your inputs and input services from registered vendors. That condition is not there applicable for the old scheme. So there was no stipulation, payment of RCM if you are not paid from unregistered vendor. That will be not there in the old scheme. However, what will happen in the new scheme if you are followed with the new scheme? In the new scheme, if you are going for a sale of an under construction flat which falls under affordable housing, then you need to charge 1% of GST, and again that no ITC will be available. In case of residential units other than affordable housing, it will be 5%. In case of commercial units in RREP project, so I said earlier, RREP is residential real estate project where total carpet area of a commercial units are less than 15% of the total carpet area of the entire project. So if the carpet area is less than 15%, though it will be still considered as a residential project. And on those commercial units also, you need to charge GST at the rate of 5%. In all the first three scenarios, ITC will not be available. And what happens to that? Due to which the compulsorily mode of payment for your GST liability will be cash, since there is no ITC eligibility. However, in case of commercial units which are sold in REP, so other than RREP, so where the commercial area is more than 15%, so in those projects, the commercial unit will be considered for a GST rate of 12%, and where proportionate ITC will be available. In case of projects where the entire project is commercial, exclusively commercial complex, so again GST will be applicable at the 12%. Now, in both the cases of commercial in REP or exclusive, here ITC will be available, and the option will be there for the assessee to either discharge his liability to cash or through credit. So this is just a synopsis what we have created here. So let's say, okay, going a short thing, if there are two projects, if the SSE has opted for the ongoing project, is the ongoing project and he has opted for the old scheme, if it is a residential property and if he's going for affordable, then 8%, non-affordable 12%, and ITC is available. If he has projects, either be it RREP or REP, affordable 8%, non-affordable 12%, commercial 12%. Again, ITC is available. If it is entire commercial, still ITC available at the GST rate of 12%. But what happens if is opted for a new scheme? So if it is a residential project, the entire project is residential and you are falling under affordable scheme, then GST will be at 1%. If you are falling under non-affordable scheme, then GST will be applicable at 5%. In both the scenarios, ITC will not be available. Vis-a-vis, if there is a mixed project, RREP, where commercial area is up to 15%. In that case also, the project will be considered as a residential, and in that case, affordable 1%, non-affordable 5%, and commercial 5%, again, without any GST, ITC. In case of REP, where commercial area is more than 15%, in that case, affordable 1%, non-affordable 5%, and commercial 12%. And here, ITC will be available for the GST liability in case of commercial sale, proportionate to whatever commercial is. And in case of if entire project is commercial, then yes, 12%, entire project 12%, and the entire ITC will be available. So whenever we are using the terms affordable, so what does actually affordable mean? So in case of metropolitan cities like Bangalore, Chennai, Delhi, NCR, Hyderabad, Kolkata, Mumbai, and other MMR regions of Mumbai, metropolitan region. So in these areas, if these are fall under your metropolitan cities, where the carpet area is up to 60 square meter and the value of the flat is up to 45 lakhs, then it will be considered as an affordable house. In case of non-metropolitan cities other than Bangalore, Chennai, Delhi, Mumbai, Hyderabad, where the carpet area is up to 90 square meter and still the amount is still up to 45 lakhs, then this will be considered as affordable housing. In cases of apartments of ongoing projects in a special scheme, so special schemes like Pradhan Mantri Awas Yojana, Rajiv Awas Yojana, where the promoter has opted to not to continue in the old scheme but go for new scheme. If they are going on, then these projects and these flats will also still be considered as affordable for the purpose of the new scheme. So when we say 45 lakhs of the value of the flat, what one need to consider? So how to compute that 45 lakhs? So in order to compute, what one will consider? Consideration which is paid for the value of flat. If there is any amount that has been recovered or charged for the transfer of land or undivided share of land, that will also be considered as a part of 45 lakhs. And if there are any development charges, parking charges, preferential location charges, common facility, or any other similar charges that has also been recovered, then that will also be considered as a part of 45 lakhs for the calculation of 45 lakhs. Usually, depends on builders to builder and SSE to SSE. There are some other additional charges that are also collected, like infrastructure charges, extra amenity, society formation, furniture, legal, share capital, clubhouse, advance maintenance, etc. So where the queries are being risen, whether this needs to be considered for the calculator of threshold of 45 lakhs or not. As per our view, apart from clubhouse and advance maintenance, all other charges needs to be considered as a part of 45 lakhs, as they are not separately, captured in an agreement or so like that. Clubhouses and advance maintenance are a separate charge of service on which GST is usually charged at 18%, and hence they are not to be considered as a part of 45 lakhs for the calculation of that threshold of 45 lakhs. Okay, friends. Now, if one has decided to go for the new scheme, if someone has gone for a new scheme, so what are the conditions that one need to follow? So if someone has to go. So one thing which I just missed out earlier, if there is any project that has started post 1st April 2019, then there is no option for the old scheme and they compulsorily have to go for the new scheme. There is no option. They have to go either for the 1% or 5%. So just wanted to make clear on that front. So if one has opted for the new scheme or someone who is under the new scheme, one thing is that they have to charge GST either at the rate of 1% and 5%. No ITC will be available to them. That means the entire GST liability has to be discharged through cash. So in case of ongoing projects where, some of them have selected a new scheme. So what happens to the ITC that has been availed? So government came out with the notification for those things also. So in case of any ITC which has been availed from inception, either from inception of GST or inception of project before 31st March 2019 till March 2019, whatever ITC that has been availed, and any of the ITC which is attributable to installment of those projects which is received after 1st April 2019, in proportion to all those installments after 119, in proportion to that, the builders was required to reverse the ITC. And then was a clear formula that was given, even transitional credit will be considered for the above reversal. And this reversal was required to be done before filing of September of 2019. The government was good enough, that they had given an option. You can use your ITC ledger or even a cash ledger to make the payment of this reversal. Now, one of the queries that had come initially, and still there might be some queries, okay, what happens to, transitional credit? So if there is an SSC and multiple projects were going on till 31st March 2019, or at the inception of GST, multiple projects and going on, and all ITC in relation to that was passed on as a transitional credit. So now coming to this, if I want to reverse the transitional credit in respect of this new scheme, how do one allocate the transitional credit between the projects which are ongoing? That is a question that still we are also looking for answers. But yes, this can be a point of litigation in future if one has availed the transitional credit for the same. One of the conditions, if one is opting for this new scheme, is that 80% of your value of input services which were used for supplying of construction service for the projects which were used, for the projects which are in the new scheme, 80% of the value of the input or input services had to be procured from your registered vendors, GST registered vendors. They are very clear on that. 80% of them has to be procured from 80% from the registered vendors only. In case if there is any shortfall for that 80%, whatever the shortfall is, the builder or the promoter will be required to pay GST under RCM at the flat 18%, other than whatever cement is, which will come later on, at the flat 18%. So irrespective your input is of 5%, 8, 12%, whatever it is, you need to pay GST under 18%. For calculation of 18%, they have clarified the development right, high-speed diesel, electricity, FSI, motor spirit will not be considered. That's a good thing for this. But for any other, if there is a shortfall, flat 18% needs to be there. However, one thing they made extra clear, that in case if there is procurement of any capital goods or any cements from an unregistered vendor, irrespective whether they fall under the shortfall of 80% or you have crossed the 80% barrier, if you have procured any cement from unregistered vendors or any capital good, the GST have to be paid directly under reverse charge. And in case of cement, it will be 28%. And in case of capital goods, it will be whatever the rate that is applicable. So one need to bifurcate, if there is cement from an unregistered person, straight away 28% will be levied. So in order to, how do one calculate? So government has come out with the guidelines that every builder will be required to maintain a project-wise, not as per company-wise, but as a project-wise details of on-inward supplies that has been availed from registered person as well as unregistered person, and then calculate the shortfall if there is any. So this is, friends, this is a huge task. I'm not sure how many builders in India have started following this thing, but in case of any assessment in future, department might rightly ask you the details of project-wise inward supplies and how much you have availed from registered and unregistered vendors. In case if there is any shortfall of 80%, then the differential, the GST under differential needs to be paid at the rate of 18%, and the time of supply of such shortfall will be end of the quarter, like June, end of the quarter of the subsequent financial year. So let's say for the example, it was financial year 22-23. The last date will be 30th June 23, by which the shortfall needs to be paid. However, in case if there is procurement of unregistered vendors in case of cement or capital goods, then the monthly payment is required and not, you cannot wait for in respect of cement, you cannot wait till the end of the financial year, but on monthly basis, you need to pay GST under RCM at the rate of 20% in case of cement and applicable rates in case of capital goods. Now coming to, so this is just basis of what was their pre-GST, pre-April 2019 and post-April 2019, what were the new scheme and not. Apart from new scheme, one of the major changes that was there was taxability on, developed TDR, FSI, lease premium. Before April 2019, what was the stand? The stand was department was very clear. In case of, there was a transfer of TDR or FSI, GST had to be rightly paid at the rate of 18%. Department was very clear that such rights are not part of land. There is a legal view. Such TDR or developments is nothing but a right in lands only, and since it becomes part of land and hence not liable to GST, our department is very clear and GST is liable at the rate of 18%. In such cases, before April 2019, all the landowners and suppliers of TDRs were directly liable to pay GST. And the GST was required to pay at the time, when there was an irrevocable transfer of development rights and TDR. And that too at the flat rate of 18%. However, the benefit before April 2019 was the service recipient, that is builder or developer, was entitled to that ITC. However, post-April, with effect from 1/2019, there has been drastic change in taxability of development rights, TDR and FSI. So here they have bifurcated TDR for residential apartments and for commercial apartments, and taxability of the same is little bit different for both of them. So first we'll discuss about residential apartments. So in case if there is any transfer of DR, TDR, FSI for under construction residential unit, then friends, that is exempt with effect from 1st April 2019. Any TDR or DR used for under construction for residential unit, the same is exempt. However, it will be taxable to the extent if there are any unsold residential flat till the issue as on the date of issuance of completion certificate. So in simpler words, if one transfers the TDR, at the time of transfer of TDR, if the TDR is to be used for residential unit, no GST. However, at the time of completion certificate is issued, if there are certain unsold residential flats, then to the extent of those unsold residential flats, GST will be payable on TDR. So vis-a-vis, if there are some unsold flats, then ultimately the point of taxation will be the date, not later than the period in which the completion certificate is issued. Now, one biggest change is in earlier, whoever was selling you the DR, TDR, he was responsible to pay the GST. However, in post with effect from 1st April 2019, the promoter developer will be the one who will be paying GST on that proportionate part of unsold residential flat under reverse charge. Not by the seller, but by the promoter developer under reverse charge. So what implication does this bring? The implication it brings that if you have opted for this new scheme, then whatever the cost which you have paid under reverse charge, the promoter developer who has paid under reverse charge, that will be a cost. Or if he is still in the old scheme, then yes, ITC is eligible to him. But under new scheme, this entire RCM payment will be a cost to them. Now, coming to that, if yes, okay, promoter developer needs to pay GST under RCM. So under what value or on what rate? So there also they have come up with the clarification that the GST applicable on such unsold, on such TDR in proportionate to unsold will be 18% of the value of development rights, TDR or FSI. Now, what will be the value of such development rights? So, in case if the TDR has been an outright purchase, so in that case, the monetary consideration will be considered as a value for the CDR. In case of revenue sharing, so whatever monetary consideration which we have paid to the landowner, that will be considered as a revenue share. That will be considered as the value of TDR. Or in case of area sharing, in such cases, the value of any similar apartment that has been charged by the promoter from independent buyers nearest to the date of transfer of TDR, that will be considered as the value of TDR. So once you have arrived at the what will be the value of TDR for this particular transaction, 18% on such value, and that again in proportion to the carpet area which has been unsold. However, the tax on TDR will never exceed 1% on 5% depending on affordable and non-affordable housing of the value of unsold flats. So if there are such unsold flats, so whatever GST rate, 1% or 5%, whatever that applies to such value of unsold flats, the TDR GST cannot exceed those value. And while calculating value of such unsold flats, one can say, so it can be same, it is deemed as equal to value of similar apartments which is charged by the promoter nearest of completion date or the first occupation, whichever is earlier. So if there is any nearest to the date of completion, if there has been a sale of flat, the same value can be considered for the value of such unsold flats. Now coming to the commercial aspect. So if there is the usage of TDR or FSI is for the commercial apartments, then friends, there is no exemption. The exemption is there only if it is used for the residential part. If it is used for a commercial apartment, then directly GST is applicable rightly at the point of outright purchase. If if there is an outright purchase of this TDR, then date of transfer of TDR will be considered, and that day GST needs to be paid. If in case of area sharing, then not later than whenever the completion certificate or first occupation, whichever is earlier, not later than that GST becomes applicable. And in case of revenue sharing, again, revenue sharing, there are probable use case. In case of revenue sharing, what can be the due date for the payment of tax? So it can be either date of execution of DA, JDA, actual date of payment of revenue share, or completion. What we feel that it should be actual date of payment of revenue share, since we feel that it's more of an accurate way of identifying the probable value of such TDR and development rights. So the difference between commercial and residential is that residential, no GST, and GST is only proportion to the unsold flats. So if all the flats has been sold till the date of CC, then no GST is applicable on such TDR if it is used for residential. However, in case of commercial, irrespective whether sold, unsold, whatever might be the case, GST is payable. The only common thing is that in both the cases, GST will be payable by the promoter developer under RCM. In this case also, the GST rate, since there is no concept of unsold portion of the commercial premises, the tax rate will be flat 18% on value of TDR. Again, for value of TDR or DR, in case of outright purchase, it will be value of monetary consideration. In case of revenue sharing, it will be consideration paid to the landowner as his share. Or in case of area sharing, again, value of similar apartments at the time of date of transfer, whichever that same is available, you can use it for the value of for payment of GST at the rate of 18%. Friends, now in residential, in case of ITC, if the builder and developer is in old scheme, ITC was available. In case of new scheme, ITC was not available. However, in this commercial, since ITC is available, so different scenarios which falls is if it was for exclusively commercial projects, entire ITC is available if it is paid under RCM. In case of REP, other than REP, where commercial area was more than 15%, ITC is available to the proportionate or attributable to the area, TDR use attributable to the commercial portion that can be claimed again for as ITC. And in case of, RREP where, commercial area is less than 15%, ITC is not eligible since on that commercial portion also GST is being paid at 5%. So in that scheme, no ITC is available only except when the builder is still under the old scheme. In that case, ITC is still be available. From here on, I would like to give the presentation hand to Mr. Parag Mehta. So he will be the one who will be carrying forward this presentation. Over to you, sir.
Yeah, thank you, Ankit. So, friends, this whole genesis of how would be the tax be payable on area share or revenue share now is derived from notification number 3/2019 to 9/2019. So now we'll take it forward. In case of joint development area sharing, there is a slide. What we can show is, in case there is a landowner who is also a joint developer, he gives the development potentials to the developer, partial or full. And in turn, if one looks at it, the developer gives him area. So then there is a customer in between. Developer sells his portion of apartments and a owner sells his share of apartments. So landowner, in lieu of development potentials, gets some area which is sold by him directly to the customers. A developer receives the development potentials, gives the area and sells his own apartments. Now, what are the tax implications of above arrangement for residential or commercial complex? So if you look at it, how the whole thing goes about as per the notifications also. Landowner transfers development rights to developer. Landowner receives consideration in form of constructed apartments. In today's time, if one looks at it, most of the arrangements are area share or revenue share because it's not feasible or cost effective to buy land by all the builders and developers and make an ad hoc payment at the first phase. So landowner receives consideration in the form of constructed apartments. So what is the time of supply for the transfer of development rights? Time of supply arises on irrevocable transfer of development rights. Now, what is irrevocable? Irrevocable is after happening of some event, as mentioned in the agreement, this development rights cannot be revoked. Now, what is the due date of payment of tax on development rights? So the due date of payment is any time up to the completion of project. So transfer of development rights, TDR, lease rights on or after 1/4/2000 is exempt where it is used for construction of residential apartments sold before issuance of completion certificate. Development rights, etc. used for construction of commercial premises, including those in RREP, is to be paid by developer under RCM. Construction of residential apartments to be sold after completion, that is unsold apartments as on date of OC, payable by developer under RCM. So what it means is, at the time of sale, the owner is not liable to pay any GST on transfer of development rights, the landowner. All the liabilities, owners, is on the builder developer to discharge GST on transfer of rights on or after 1/4/2019. So take it ahead, Ankit. GST payable. Now, as it is explained earlier, how is the GST payable by developer under RCM on development rights? As given earlier in notification number 4/2019, for construction of commercial apartments, value of development rights shall be deemed to be value of similar commercial apartments charged by promoter from independent buyer nearest to the date of transfer of development rights or FSI. Tax rate will be 18% thereof. So to explain in brief, if there's a 1 lakh square feet being allotted to a landowner and the first sale agreement to an external buyer is at a value of 10,000 rupees, then in case of a commercial apartments, the value of development rights would be 1 lakh square feet into 10,000 into that is the value, and on that 18% will be payable. However, as it is for commercial apartments, entire ITC is allowed, though the time is given up to the date of OC, but it always makes sense to make the payments a bit earlier to avail of the ITC. Now, in case of residential apartments remaining unsold on the completion, so tax payable, there is no liability on the landowner. Again, we repeat, the liability is on the builder, developer, promoter. So tax payable will be lower of 18% of development rights attributable to unsold apartments or 5% or 1% of value of unsold apartments. So now when we mention 18% of development rights attributable to unsold apartments means, like if in a residential project, 1 lakh square feet is given to a landlord, value is 10,000, and the unsold inventory on the date of OC is 20%. So 1 lakh into the value 10,000, the first sale agreement, into 20%, which is the unsold proportion, multiplied by 18%. So the GST is payable, the value of development rights only attributable to unsold apartments will be taken for the valuation purposes. Or second is 5% or 1% of value of unsold apartments. So the 20% area which is unsold, the value shall be deemed to be the value of similar apartments charged by the promoter nearest to the date of completion or first occupation. For development rights, if we look at it, it is similar apartments charged by promoter nearest to the date of transfer of development rights. But in case of unsold apartments, it shall be at the date of OC, the value of similar apartments charged by the promoter. So 18% of the development rights attributable to unsold apartments, or 5% or 1% of the value of unsold apartments, whichever is lower would be the tax payable at the time of OC. So developer. So here if one looks at it, construction of owner's apartment is considered a service by developer to landowner which is liable to GST. Though this is today pending before Honorable Supreme High Court in case of Vasanta Greens for service tax regime, wherein Hyderabad state held that service tax is not payable by developer on owner's share. The logic given was the cost of area constructed for the landowner is already recovered in the sale component. Now, why should it be charged again on the landowner? And the GST service tax has already been paid at the time when the buildings, the units were sold. Hence, this is amounting to double taxation. Now, it's pending before the state is in favor of the SSC, but the department has filed a petition in Supreme Court. So we'll have to wait for the Vasanta Green projects, which may have an impact in the GST regime also. Developers shall pay tax on owner's area at the time of completion certificate or first occupation, whichever is earlier. However, now notification number 3/2021 has allowed a developer to prepone tax payment on landowner's area to enable landowner to claim ITC thereof. So the only reason for allowing preponement was if as one is aware, when in case of a area sharing, the area which is allotted to a landowner is liable to GST, and when it is sold again by the builder, by the landowner, he under before OC, he has to charge the GST. So there is only a provision made that the landowner can take the offset of the GST charged by the builder and developer. So in case the GST is charged at the end and the landowner starts selling his units earlier, then there will not be any set off available to him at the end. So notification 3/21 has given a choice. It's not a compulsion. It's given a choice to developer to prepone the tax payment of landowner's area. GST is to be paid on value of total amount charged for similar apartments in the project to independent buyer nearest to the date of transfer of development rights. And further, developer is liable to GST on sale of under construction his own sales at 5%, 1%, or 12% subject to conditions mentioned in notification 3/2019. Further, landowner is liable to GST on sale of under construction apartments. Developer will also charge GST at 5% or 1% on apartments charged to landowners. Developer can pay GST on earlier of date of completion of project or first occupation. Landowner, as mentioned earlier, is entitled to input tax credit of GST levied by developer on construction of owner's flat, subject to cap of output tax payable on residential or commercial apartments sold under construction. If developer pays tax on completion of the project, landowner will not be in a position to avail or utilize ITC. So this condition has been allowed to prepone the tax payment. Further, GST in respect of apartments units remaining unsold in the hands of landowner on the date of OC will become to cost to the landowner where developer has charged GST on area allotted to him. As of date also, so in case 1 lakh square feet has been allotted to a landowner, he on which GST has been charged by the builder developer, he has managed to sell 75,000 units, 75,000 square feet, 25,000 square feet are unsold. In that scenario, the 25,000 units GST which has been charged by the builder developer will not be allowed to be offsetted against excess recovered on 75,000 units, 75,000 square feet, but it will be a cost for the landowner. Now, commercially, it's a different thing. Who bears the GST? That depends on each and every separate commercial. But the liability is of the builder developer, whether he recovers it from the landowner or he does not recover it from the landowner. So, for the developer, GST is payable on sale of under construction apartments. ITC not available for inputs and input services, including development rights. Proportionate ITC relatable to under construction commercial units is allowable in case there is a project with 70% residential, 30% commercial. In that scenario, 30% ITC would be allowed to the builder developer, but 70% will not be allowed. ITC reversal on unsold commercial units to be done as per Rule 42 on 43 on area basis and for entire project period. So rules 42-43 have also been amended from 1/4/2019 to provide it on area basis for builders and developers instead of amount of exempted and taxable income as was the rule earlier. Now friends, what we saw earlier was an area share. Now what are we referring to is a revenue share. In case of revenue share, the transaction remains the same, wherein landowner or a joint landowner gives the development potentials to a developer, in lieu of which the developer, instead of giving him a fixed area, would give him a proportionate share in the revenue. Or in this scenario, all the apartments are sold by the developer to the customers and the sale proceeds are received by the developer. Revenue share can be classified, would maybe based on commercials, it may be on the top line, a percentage of sales proceeds or realization, or bottom line, a percentage of project profit, or any other basis which may be mutually decided by the landowner as well as the developer. Now, what are the tax implications of above arrangement? So, if one looks at it, for development rights, it's the same way as it was in area share. Landowner transfers development rights. Landowner receives consideration in the form of revenue share instead of area share. So here he'll be getting hard cash based on whatever is a mutually decided basis. Transfer of development rights again is exempt for landowner, and onus is not on landowner, but it is on the builder developer to discharge GST under reverse charge basis, whether it pertains to residential or commercial. All the contents remain the same, except that instead of an area share, here the landowner receives the revenue share. In case of a revenue share, this revenue share will not be liable to GST, as the builder developer will be discharging liability on the entire sale proceeds. Next slide, please. Developer. So GST is payable by the developer on sale of all under construction apartments, 5%, 1% or 12%. Again, ITC not available. Proportionate ITC relatable to under construction of commercial units to be taxed at 12%. ITC reversal formula remains the same as per rule 42 and 43 as was in area share also. So in case what is the GST payable by developer under RCM on development rights in case of revenue share? Construction of commercial apartments, 18% payable under RCM on actual revenue paid to landowner. So as we discussed earlier, how to determine this on the date of transfer of development rights? That's an issue. So normal course and a practical purpose, it will be as and when each and every part of revenue is due. At that point of time, 18% will be payable under RCM. Residential apartments remaining unsold, again the same formula. Tax payable will be lower of 18% of the development rights or 5% or 1% of value of unsold apartments. Now, in this case, what will be the value of development rights? 5% or 1% of value of unsold apartments is fine. It would be the value of similar apartments charged by the promoter nearest to the date of completion. But in case of revenue share, the value of development rights shall be proportionate revenue share paid to landowner. So in short, if for the development rights, the landowner has received 50 crores and on the date of OC, if there is a 10% inventory which is unsold, then the value of development rights would be 10%, 50 crores into 10%, that would be 5 crores, and 5 crores into 18%, that would be 90 lakhs. So in case of development rights in revenue share, it shall be the proportionate revenue share paid to landowner in respect of unsold apartments. Now, friends, this was the basic difference between joint development agreements, area share and revenue share, implications on landowner, on the developer and the ultimate customer. Now, there are no precedents, as if one is aware, sale of development rights has been disputed from the inception of GST. There are one or two writ petitions which are also still going on, like a Telangana High Court is hearing one of the writ petitions. However, there are some legal precedents under the erstwhile service tax law, wherein the issue of free flats allotted to landowner or the society which has been considered, and there have been favorable verdicts in favor of the SSC. So if one looks at it, the main case today which is pending before the Honorable Supreme High Court is the Vasanta Green projects, wherein it has been very clearly held by the judiciary that service tax is liable to be paid on gross amount charged, that is to say consideration received from landowners in kind and consideration received from prospective customers, that is total gross amount. In the case in hand, the amount attributable to the consideration received by the appellant in the form of land rights from the landowner stands included in the value of villas sold to prospective customer, which would mean that whatever consideration was received by the appellant in form of development rights was considered in assessable value. So the judiciary has held that on the sale portion, which includes even the cost attributable to the free area allotted to the landowners, has been recovered on the sale value to external parties. Hence, this value has already been considered and it shouldn't be taxed. Now, the same logic may be applied under GST regime also. So once the judiciary decides in the Honorable Supreme High Court in the case of Vasanta Greens, one can take a further stand in the matter. In case of redevelopments of society, the free area allotted to society members, whether that is liable to GST or not. Service tax also, there are many precedents wherein the department has started initiating proceedings, recovery proceedings, and the matters are pending before various forums. So in one of the appeals, which was for Veena Realcon, society redevelopment, the Honorable Commissioner has held that service tax is not payable on the free flats given to the existing members of the society. A very welcome judgment for places like metropolitan places like Bombay, Madras, Calcutta, wherein this cost of free area allotted to society members valuation is a big issue. Second slide. Imperial Dreams homes. Again, the authority has held that service tax is not payable on the free flats given to the existing members of the society. Ethic Infra Development Private Limited. Again, it has been held that construction of rehab service is not taxable. So these were some of the legal precedents of the erstwhile GS service tax law, which may have some bearing under the present GST regime. But again, I would repeat, the entire industry is waiting for the outcome of first Supreme Court in the case of Vasanta Green, and second, 1 or 2 writ petitions challenging the GST on development rights, challenging the GST on free area allotted to landowners, etc. So thank you everybody for a very patient hearing. We would like to take up the questions if there are any. So there is one question. Is the landowner eligible for ITC claim on construction service from developer in case of residential apartments? Yes, the landowner is eligible for set off in case of residential apartments, provided it is sold by the landowner also before receipt of OC. If the area is sold after OC, it will not be allowed as a set off, it will become a cost. Further, please note, only the GST charged by the developer is allowed as a set off. Any other expenses maybe like legal fees, advertisement, brokerage, etc. incurred by a landowner, that is not allowed as a set-off. In extension of this, there's a question whether it is in case of commercial apartments. Yes, in case of commercial apartments also it remains the same. The builder developer will charge the GST on the entire portion, and in that scenario, again at the time of OC, it will be after OC there will not be any set-off. So all units sold before OC will be allowed for a set-off. After that, it will not be allowed as a set-off. Presentation, yes, this presentation will be circulated by circulated by Taxmann. Notification number that tax is liable to paid under forward charge by landowner before 1/4/2019. So if you look at it, it's an interpretation of law. Since it is not covered under RCM and development rights is liable to GST, it is automatically under forward charge. Only the services when specified, they would get covered under RCM. Hence, notifications from 1/4/2019 cover the said category. Hence, prior to that, it would be under forward charge. There's one question. In case of RCM liability on services by way of transfer of TDR FSI on unsold flats, as on the date of OC, which rate should be taken for the purpose of valuation of TDR? OC date 1st October 23, rate on 1st September 23 is 22,000 per square feet, rate on 5th October 23, that is after the receipt of OC, is 25,000. In our view, any agreement which is before the OC, nearest to the date of receipt of, before the date of receipt of OC, that value should be taken. Would have been better. Okay. So can we say that there is a double taxation in case of commercial apartments? There is no exemption for sold units. Developer will be paying GST under RCM on TDR as well as GST under forward charge for construction services. So here again, what we would repeat is, again, it is that GST under RCM is allowable as a set-off. So if you plan your tax affairs, structure it, this set-off would be allowed and there would not be any double taxation. In case of redevelopment of society, brokerage corpus and damage paid to society members, in our view, not liable to GST. Thus, notification number 4/2018 decide time of supply or it postpones the GST liability. Notification number 4/2018 does not decide the time of supply. It only postpones the GST liability payment. What is the taxability of transfer of development rights which is traded? In case of trading, unfortunately, the reverse charge notification talks about exemption only when it is sold to a builder developer. In case of trading, in our view, there is no exemption. Hence, if it is being sold to a trader, GST at 18% would be liable under forward charge. Is ITC available if construction is done for renting purpose and not for sale? Safari retreats, matter pending before Supreme High Court, all hearings done, and the judgment is expected. Orissa High Court has held that it is allowable in a writ petition in Safari retreats, but the department has filed a writ petition before Honorable Supreme High Court. All the hearings have been done. Now, a final judgment expected by 30th November or 31st of December. GST implications on JDA for development of plots. One needs to look at the JDA agreement to determine on it. Will GST come on that brokerage, corpus fund and damages? If yes, in our view, it will not be payable on brokerage, corpus fund payable to the society members. Sir, on the date of OC, if ITC balance is there, is the entire ITC balance to be reversed? You will have to follow rule 42 and 43 and accordingly reverse the ITC. What will be the treatment in case of JDA done for sale of developed plots? One will have to look at the development agreement to really comment on it. GST is applicable on sale of developed plots. Development means road, electricity line. So in developed plot, I would say if it's a plotted land, there is a clarification issued by the department that no GST would be applicable on it. For computation of TDR on residential units, do we consider the units belonging to the landowner to be sold for computation of exemptions, even though it has not been sold to a third party? As you are charging full GST to a landowner, it is considered as a sold unit. I think so we have managed to answer all the questions. However, if still there are any questions, feel free to connect with Taxmann and they will forward to us. Thanks a lot from Parag Mehta and Ankit Joshi.